Books, right? One of it is how can they actually deal with their fixed assets. That's number one. Then others talked about inventory. Then a lot of other um, um, a lot of what will I call it? A lot of requests. So let's start by logging into Zoho Books. So I want to say Zoho Books. So we can quickly click on any of the Zoho Books that is already opened. So let's click on these Zoho Books and let's see what comes up. So it's actually loading. So we have to give it time to actually finish loading. Okay, so yeah. All right, so this is okay, so it's trying to reload. Yeah, so I've just opened our accounts now. So this is what we have currently. Let me go to the home page. Let me be sure. Okay, so this is what we are actually using. So what we want to do today, the last time we met, we were able to like get certain transactions into our chart of accounts. Okay, so we're able to impute certain transactions, like certain accounts heads, especially the one that has to do with the control account. For instance, if you want to pay salary, how to treat that. I think we've done that in the last class. We treated a salary, then we only created a provisions for it, meaning that we didn't actually record the actual salary. Okay, so let me quickly go and open that file that we are using. Let me just open a file over here. I call it chart of account. Okay, so let's open this chart of account. Want to open this chart of account. Let's see what happens. Okay, so let's work with this chart of account. Yeah, so the last time we met, we were able to like actually create this journal based on the what I explained to us. So you discover that no matter where your let me use this one. Okay, so no matter the numbers of transactions that you've decided to use, right, you might need to have something this way. Okay, so now the first one I opened, so this is like a normal one. You already have your gross salary. This is your gross salary, right? So it's going to be debited. Your gross salary is going to be debited into the admin salaries and allowance, and this is what goes to your POL. This goes to your POL as an expense. Then you now credit this account. You credit your accrued salaries and allowance payable, which is a control account. So this amount is what is going to be your net salary after you've deducted every other thing. So the net salary payable, this is what is going to be, okay? So it means that even without you actually paying salaries, as far as you are aware of the salary that is payable at any certain point in time, you can go on to create your you can go on to create what I just showed us now. So where did I see that? Is this saved here? Oh, yeah, so this is it. So you can go on to create these this journal, right? So the journal is like you have your gross salary, you debit your gross salary, then you credit all these payable accounts. So you credit these accrued salaries and allowance payable with this value, which is your net salary that ought to go to the staff account, right? Their take home. This is their take home. So this is what their take home ought to be. Then the next one, you also have you pay government, pay as you earn. So this is a value. Then if there's a pension amount, this is the value they have to pay to pension. And this pension was actually deducted from the staff salary. And this is like what we call 8% of the staff salary. So in case you have any question or anything, you can actually raise your hand. I'm going to notice it, or you can drop a message in our chat box, and I'm going to actually attend to us. Okay, so let's go on. Let's move on. Moving on. So I've shown us this. Then the next thing you want to also take note of is that when you have deducted that 8% from the staff salary, you need to actually remit it on their behalf to their pensions account. So that's why it's on the payables side. Okay, so all this now, they go into the balance sheet or the statement of financial position. All this one go to the statement of financial position, while this goes to the profit and loss account. Then another thing that you also want to take note of is your employer's contribution. This is 8%, while employer is going to pay, is it 10%? So most times to get this employer's contribution, just equal to this times 10/8. So you're going to get your employer's contribution. So I think the other day we posted this journal already. But what happens when the normal salary that you normally pay, right? The normal salary that you normally pay, okay, you already have your gross salary as the case may be, then you have what your net salary should be, right? However, because you actually didn't, let's say there are some people that they didn't come to work fully for the month. Some came late. There are certain deductions that you've done, okay? So most of those deductions that you've done, naturally, your net salary that's supposed to go to them is this credit value. However, let's assume the amount ought to be more than this, but because you ended up paying them only this value, then whatever is remaining that you have deducted from their salary, you post it to retain earnings. I just wanted to show us this one. So you post it to retain earnings. How do you do that? By, let's assume initially we've already mentioned that this our net salary is actually this amount. But when the time comes and then you now discover that you didn't actually pay up to that, then you might need to debit. You might need to debit these your salaries and wages, okay, and then you now credit your equity, okay, to create that into your retained earnings. So when the time comes, I'm going to show us that so that it doesn't look like I'm just saying a lot of stories and then we are not seeing the right thing that we ought to see. Okay, so let's go back to now. Another thing we're also going to work on is we're going to work on assets. We're also going to work on how to capture the depreciable amount of that asset. So we're also going to use a journal to also pass that. But also don't forget that when you're dealing with assets, you need to have an asset register. You also need to have a place where you always depreciate your asset. Okay, so we're going to look at that also in this training. So let's quickly go back to our let's go back to our Zoho. Now from our Zoho now, we want to go and pass some entries. We've already created some journals the other day. If you come to a journal, our manual journal, we've passed these two journals, right? We've passed these two journals and then we can actually view them. We've published them as well. So can we view them? Let me see if we can view them. Okay, so this is the journal that we actually passed the other day. So we talk about our pension payable, our pay as you earn, our salary accrued account. Then we debited our admin salaries and allowances. So this goes to profit and loss account, while the other three go to your balance sheet. Okay, so we've done that. Then we also came over to the next one to also do for the we also did for the directors portion, the company's employers portion. So let's now come to our expenses. So since we have that done already, let's come to our expenses. So under our expenses, right? So what we need to do is, let's assume we now finally decided to pay the salary. But before we do that, let's just go and have that figure in mind. so that we can use it whenever we get back there. So this now, let's check the figure again. Let's see. So for our, okay, so this for our net salary, this what we actually ought to pay to the staff. So this is what we ought to pay. Then for our pension, sorry, our pension, this is what we need to pay. Then our pay as you earn, this is what we need to pay. So let's go and capture all these things now. We now come to our Zoho books, we come to our expenses. Now, at the point of actually passing that journal entry, those salaries, they've not actually been paid, right? They've not actually been paid. But because your accounts, they are periodical, you make sure that on accrual basis, make sure that every expense that ought to be in that account at that particular point in time, you already create a provisions for them. So we're just creating a provisions for the salary account, and then that's why we have debited the what's it called, our POL with the gross amount of the salary. We have debited that of the salary. So what we are going to do is, that's the provision that we now created to the liability section. We created all those liability heads. Okay, so let's now assume that now we now want to pay our staff. Okay, it's now month end, we want to pay our staff. Just simply come to your expense, right? Normally the way you normally create your expense, then come to new expense. When you come to new expense, then let's assume today is the date we are paying them. Today is 28th of February. Then account type. Now you now search for the account type, the expense account that you actually want to create. So now, because it's salary we want to pay, don't forget that we've already debited profit and loss account with the gross amount. So what we need to do under this expense account, now look for your payable. Look for your payable, okay? Because this expense, we've created it already in our profit and loss account by passing that journal, okay? So what we want to do is that we now come to our payables, we will now see accrued salaries and allowances payable. Don't forget that it already has a credit balance because it's a liability account. It already has a credit balance. So now, in order to now pay, to say that, okay, we've actually settled these people, we now come to the amount, we now put the amount that we are actually paying. So this is the amount that we paid. Then tax exclusive is fine. So we are paying it through, let's say we are paying it through Fidelity account. Then what else? No tax allowed, no vendor, no reference number. So we can put a note. We can say being the net amount of February salary to the staff. Okay, so that is fine. Then no need for any customer name, no need for anything. So let's just come here and click on save. So you discover that what I just did now, I didn't create any additional expense, because most people that are just coming up in posting, they feel that anytime we pay money, that is when we need to go and create an expense. No, you discover that we've already created a provision before. It will be wrong for you to now go to your expense account and go and select your admin salaries and allowances. It will be wrong because we've already created the provisions for it already. So we've already debited our profit or loss already, and we now create a liability. So now, is that liability account that you want to post to? Already that liability account is already having a credit balance. You just need to post a debit to it so that it will reduce or net it off. And that is how we're able to achieve that. Let's also assume that, let's also go and check for our payee. Let's go back to the journal. Okay, let's go back to the journal now and see what comes up. Okay, so let's come over here. Let's check. So now the first one, yeah, so we've actually netted off our liability on salary Let's now work on our pay as you earn. So let's also copy this, right? So when the time comes that we actually want to now pay government, right? If we want to pay government, let's go back to our purchases. So let's see what happens under our purchases. So under our expense, we come to this place. We just paid payee to the government. So how do we capture it? So let's assume we also have this date. Then under our expense account, we scroll down to the bottom. We want to select payable because it's a payable. It's an liability that we want to payable. So we now have pay as you earn. So this is the pay as you earn account. Don't forget that this pay as you earn account is actually a liability account. It's a liability account. So what you now do is that you now come over here and post the amount that you are paying to it, so that already this liability account is already having a credit balance. We select it under expense. The reason is because we want to debit it. Is a liability account. Since we came over here to select it under expense, okay, we want to pass a debit entry to it. So if an account naturally have a credit, you pass a debit entry to it, it reduces the credit amount by the amount of debit that you post to it. So we now say, okay, this account, we have paid government. We don't go ahead to create additional expense. No, we've already passed a provisions already. All we just need to do is that we want to now reduce the liability that we carried in our books under pay as you earn. So we just come to the amount, then we are paying it through, let's say, Fidelity account, no tax on it, no. So who is the vendor? You can quickly create a vendor. The vendor you want to create can be Lagos State. Let's just create a vendor. So here we can decide to put, no need for this salutation actually, but let's just come to this company name. We now say Lagos State Internal Revenue. Internal Revenue Service. Okay, so that's the vendor. Then it's going to appear as a display name. It's fine. No need for address. If you have a phone number, you can put it. No need for all these. They are all fine. They just click on save. Now, at a goal, you can decide to set your computer for the amount of payee that you've paid to Lagos State government, and it's going to come out under this account. This vendor, you can search for this vendor to see the numbers of payee that you have actually paid to the government. So you can also come here and say being the pay as you earn for February. Okay, then that is fine. Then you go on to click on save. And the last one is your pension. Also, when you process your pension, so once you process your pension, you don't need to go and create additional expense because we've already debited our profit and loss account with the gross amount of the salary. Okay, and then we now created a liability. Is that liability account that we're actually writing off? So we now come here. Let's assume a pension has been paid. Before we do that, let's go and check the amount of the pension that we have over here. So we want to check the amount of the pension, and the pension amount is actually 135,000. So we copy it like this. Then we come back to our purchases, expenses, and then we want to come to this new expense, and then we want to select another payable, and which is going to be like our pension. So this is our pension account. So this pension account now warehouses both the liability of the staff. So, you know, we have collected this money from staff already, right? We've deducted 8% from staff already. That is why is created under our liability account. We are owing it. So with the one that the employer is also owing us is also a liability to the company. So you need to also debit this liability account for both the employer and the employee. Okay, you need to debit this. So the amount now for that of the employee that we deducted is this value. So we can do this. Then we want to say we are paying it through our Fidelity account as well. the vendor, if you have any pensions, PFA that you want to pay, or whoever it is, you can put them as the name of the vendor. Then no need for customer name, because this customer name is no need for it. You can put a narration, and at the same time you can click on save. So I want to believe that based on what I've explained to us, this is well noted. Salaries is not going to give us any issue any longer. But there's something I told us. I told us that in a situation whereby as the month is, most times these your provisions, you might have created it even before salaries were paid, right? You might have created this provision even before salaries were paid. So let's assume that when we wanted to create these provisions, we already knew that the net salary is going to be like, let's say like 3 million or something. Or let me look at this amount. This is this value. So let's say we already know that the amount is going to be like, this is not giving me value. Where do you know that the amount is going to be 3,188,334.35? So we already know that that is the amount we are going to get, right? So let me come here. Let me just put the amount over here. So let me say equal to this, then plus this. So at the point of creating our provisions, under this our net salary payable, we assume that we're to pay this net salary to staff, right? But what is the reality? In reality, we now discover that when we're now processing our whatever, we now discover that some staff actually did not come through or throughout the month. Some of them came late, and then we have what we normally charge them, okay, whenever they come late. So naturally, you might have posted 3 million to this side, okay, as a liability and all that. So all you need to do is that since now we did not fully pay all the salary we want to pay, we only paid 2,998,000, whatever. So in this our liability account, this our accrued salaries and wages account, it will still be showing that we are still owing some staff. That's what it will be showing us. So in order for it not to show that we are owing any staff, all you need to do is that pass whatever is remaining, debit the account with whatever amount that is remaining, then you now come and credit the retained earnings account. So you credit the retained earnings account, and that is how to go about it. So let me unmute our mic. Let me be sure that majority of us we got what I just explained now. So that let me unmute our mic, and then there is somebody sending us a chat. Please repeat the formula for computing of employer's pension. Oh, okay. So for that, once you already know the amount for the employee is 8%, right? To get employer, just come here, just say equal to, you know that the employer ought to pay 10%. The employee contributed 8%. Just say 10% over 80, over 8, 10 over 8, then times the amount that we deducted for the employee. And it's going to give us something is wrong. Oh, it's equity I did it onto. Sorry, not equity. Okay, so times this, our pension, okay, and then that's how we're able to get this. So employer is supposed to pay 10%, employee contributed 8%. So if you come here, you say equal to 10 over 8 times amount the employee contributed, you're going to get what the employer should contribute. So let me unmute our mic. Let's quickly have this done. Let me get that you understand how we're able to navigate to know that, okay, whatever is remaining, because in your salary account, you already assumed that you are supposed to have, they're supposed to pay them this value, okay? They're supposed to pay them this value. Let me come over here. Sorry, you're supposed to pay the staff this value. However, you're supposed to pay the staff this value. However, what you eventually paid was this amount. And then you now check. You are not actually owing anybody again. You have paid everybody. Why is that? Because some staff did not come all through the month. Maybe some of them decided to go on anywhere they want to go to, and then you did not grant their leave or whatever it is, and maybe some of them came late, and then you have been deducting their salary for that. So at the end of the day, you ought to pay them this amount. You finish paying all of them, and you have paid them 2.9. In the account, in this liability account, there's a value that is still going to be remaining in that account. Okay, so what you need to do is that you just go and debit this account by whatever is remaining, debit it, and come and credit your retained earnings account with whatever is remaining for that period. I hope you understand that. If you understand that, give me a thumbs up, then we can move ahead to how to go and treat our assets. Let's work on asset now. If you get it, let me see a thumbs up from us. Okay, so that is fine. Ms. Anu actually understands. So let me just give us 2 minutes to actually ask question if possible. Then we can go on to look at assets. So 2 minutes, your mic is on. Does anybody have any question based on what I just explained? If there's no question, then we can move ahead. So let's go on. Let's go on. Your mic is already unmuted, but let's go on. So now let's come over here. Let's assume we have some expenses for assets. I keep telling people that the difference between assets and expenses, they both have debit balances. Okay, so let's come to our asset account. Under our expense, we want to record that we actually purchase an asset. So let's come over here and we create new expense, right? So under the new expense, we come over here, then want to select, let's say it's today, want to select an asset now that we purchase. Let's just check for assets. So this is cost of sales. This is consultant expense. Let's just search for motor vehicle. Let's just search for motor vehicle. Okay, so we have both accrued and then we accrued expenses, accrued depreciation, sorry. So we just click on motor vehicle at cost. So now, these are motor vehicle, just like the way we normally do. Whenever you purchase an asset, what do you normally do? Debit the asset account, credit your bank, right? However, if it's a situation whereby you didn't actually pay for that asset, you debit the asset account, which is the motor vehicle, and then you now credit the vendor that actually gave you that motor vehicle, so that you know that, okay, you didn't pay for it. The vendor actually paid for you. So to know that, okay, you are owing the vendor. So now, but because we assume that we have paid for this motor vehicle, how much is this motor vehicle? Let's say the amount is, 5 million or 3 million. So let's say it is 5 million, 1, 2, 1, 2, 3. Okay, so that's the amount. Then we paid through. So we are debiting, because it's an expense account, we are debiting motor vehicle account. Then we want to credit the bank. Where did we pay through? We paid through Fidelity Bank. Okay. Then who is the vendor that supplied us the motor vehicle? Let's try and get a vendor. Let's say Mr. Wasiu Aina was the one that supplied us. We can put a reference number, we can put a note. So we can say being the costs of Benz 305. I mean, what do they call? I don't really know much about vehicle. Okay, so Benz 305. Okay, then yeah, so this is our asset, right? We don't need to input any customer, okay, because our asset. So once we've captured all these, we can go on to click on save. Okay, so we've already recorded an expense, right? By debiting the expense account, by debiting the asset account, right? And then we now credit bank. Okay, so that's what we just did now. So we'll be able to do this. So if you now want to create depreciation for this vehicle now, this vehicle was purchased at the end of February, right? At the end of February, that's when it was purchased. So therefore, if you want to capture I'm sure, obviously now you cannot capture any depreciation for it because the vehicle is we just purchased it this month, and this is the end of the month, right? So that means the first depreciation that we're going to pass to it might either be at the end of March, right? So what you want to do is this. Normally, how you normally create your let me go and search for let me search for fixed asset. Let me search for fixed asset. I just want to use this to explain something to us. Fixed asset register. Okay, so I have this fixed asset register. I want to click here, and if I click and open it in so let me check. I don't want this. Do you want to save changes to this? No. Okay, so no. All right, so I want to open it with Excel. So I want to open it with Excel, and here we go. So I want to show us this fixed asset register so that once we're able to capture, okay, so let me just come over here and close certain things, enable content, and then continue, and then want to click on close. Yep. Okay, so here we go. Yeah, I'm coming. Let me see. Is this what I'm looking for? Book value. I'm not sure this is what I'm looking for. This is not what I'm looking for, actually. This is not what I'm looking for. So this is not actually what I'm looking for. So let me close this one. I don't want this. Yeah, so let me search again. Fixed assets. I'm coming. I just want to show us so that we are guided, we know what you're doing. So let me search for fixed asset again. Fixed assets, register, fixed assets, upload format for these. Tell me, Lore. I'm coming. Let me check for this one. Okay, let's check this one. Okay, I think it's still the same thing. Okay, I don't want to use this one. Yeah, but I just want to show us how to actually achieve that which you intend to achieve. Let me search for, let me come over here. Let me search for fixed assets. Fixed assets. Fixed asset. Fixed assets. Fixed asset. Just give me 2 minutes, please. I want to search for it. No. So the fixed assets, I'm looking for it. Okay, let me check here. Yeah, I have it over here. So yeah, somebody is trying to raise his or her hand. You have any question? Or mute your mic. Okay, so yeah, so this is a fixed asset register I want to show us. So the first thing that we have over here is the rate of depreciation. How do we charge depreciation? So you have to have it here. Depreciation, this is item of property, plant, and equipment are depreciated from the date they are available for use or in respect to capital work in progress for the whatever. So now then we have the rate at which we actually depreciate. Furniture and fittings, 10%. So this is like the policy of the organization, okay? Different organization, they have their different policy. Just know that the only thing that is uniform is only the, what's it called? Is only capital allowance, right? But for depreciation is actually not uniform because different companies have their different ways of depreciating their asset. So it's not uniform the way companies depreciate their assets. So now this company has their own policy, and then their policy is that they want to depreciate furniture and fittings by 10%, equipment, office equipment by 10%, motor vehicle by 20%, and building by 10%. Then another thing we want to look at, we have fixed assets registered by year, by the year that we purchase them. So we have 2015 assets. We have different years that we purchase them. Okay, so we have this serial number, the date, the class of the asset, the description of the asset, right? Then the supplier's name, the reference number, the index number, the amount that we actually purchase that kind of asset. Then in front of it, you're also going to be seeing the depreciation amount. We are going to have our 10%. This is the cost of the asset, right? So we are going to have our depreciation rate based on our policy. Our policy at the beginning of this place, we already said most of these things are going to be 10%, except for motor vehicle that is going to be 20%. So when we're depreciating by year, we are having 7 months in 2010. So this asset is going to be depreciated for 7 months, right? By saying these costs times the depreciation rate, right? Then we now say 7/12, because they say it's for 7 months, like that, or 12 months times. So we say these, okay, divided by 12 times 7. Okay, that's fine. So that is how we did this. So this is like depreciation by year. Let's now check the difference between by year and then by class. So by year and by class. Okay, let's check for by class. So this is depreciation by class. Let's go to the beginning of this sheet. Okay, so by class, we are going to go straight to the right and see the difference between it. All right, 12 months as well. Okay, so this is actually just a natural paste. Is not actually. So I feel there is actually no much difference between by class and by year, save for, let's just be sure. So this is office building. This is class of asset. Then over here, this is class of assets as well, office building. Then year is here. Over here also, we have year over here. Then I can't see any difference between by class and by year. So, but let's leave that. That is not actually what we want to actually talk about. Let's now go straight to each of these. So let me now explain. Let me go to like a more recent one. Let's go to that of 2020 first. Okay, so if you check 2020, right? So this is property, plant, and equipment. This is like the movement on this account as at 31st December 2020 was as follows. So you know that we have our motor vehicle, we have our furniture and fittings, we have our office equipment, we have our computer and whatever. So now the first thing you're going to see is costs or deemed costs. The first one, as at the 1st of January that same year, you're going to have the cost of that asset. Motor vehicle, how much is your motor vehicle that's at the beginning of the year? How much is your furniture and fittings? How much is your office equipment? How much is your computer and whatever? Then you're also going to have the total at the right. Then the next thing you want to do is are there any additions probably during the year? So there are additions. So this is the addition over here, another addition, another addition, another addition, and you add everything together, you also have it over here. Then at the end of the day, you want to get the balance as at 31st of December 2020. So remember, your asset at cost, you're just going to add the one that you have at the 1st of January 2020 plus the one you have additionally. Everything's going to give you this amount. You add everything together, it's going to give you this amount. Okay, so that means that for your costs, you want to have the cost at the beginning of the year. You also want to have additions for during the year. You also want to have it, and then you add everything together over here. So everything is summing over to this side. Now, what is the next thing you need to do? Now come over here and ask yourself, what is my accumulated depreciation as at 1st of January 2020? Remember, when you purchase most of these assets, because we have a certain percentage that we are using. For motor vehicle, we said it's 20%. That means whatever asset you purchase is assumed that that asset is supposed to last us for only 5 years. It means we need to depreciate it for only 5 years. Okay. So if we need to depreciate it for only 5 years, then they say at the beginning of the year, this is the depreciation amount, right? Then it means that this is 20%. So, and the code is this is accumulated depreciation. So we actually don't know. Number one, we don't know how many assets is here, but we know that this is supposed to be depreciated by 20%. So let's say that this amount, we want to say that's 16,000 times 20%. So let's check what that's going to give us. Let me see. We have 20 divided by 100 times this 16,000. 235,254. We are going to have 3 million. So therefore, now since this is an accumulated depreciation, it might not only be for only these assets. Probably some assets as have been used up. Okay, some assets have been used up, but just know that this is 20%, right? This 20%, and then you don't know how many years this asset has been depreciated, but we just know that the accumulated depreciation they gave us is this amount. But if you take 20% of this thing, you're going to get like 3 million. So now when you now add this plus this together, you're going to get this. Then you need to take 20% of it for the depreciation of the charge for the year. So we now took the depreciation charge for the year, and then we now had this. Okay, so that's how we now have all the depreciation for the year, all the depreciation for the year, all the depreciation for the year. So let me tell you, my people, this depreciation for the year, when you add it together, right, this is what you are going to charge to your P or L account. So what you're going to do is that you debit your depreciation account, right, and credit accumulated depreciation. So that's how to go. So in order for us to be on a safe page, let's now come to now here at the end of 31st December 2020, we're now having this value as our accumulated depreciation, right? This is our accumulated depreciation at the end of 2020, and so our I'm coming on. I'm trying to check for something. Okay, so I'm coming. This is as at the 1st of January 2020. Let me see, C9. Okay, so now we are okay. Yeah, so this carrying amount we are talking about. So as at the 1st of January, the carrying amount that we actually had at the 1st of January is the accumulated. This our cost of asset minus our accumulated depreciation at the beginning. We also have our carrying amount as at the beginning. Then at the end of the year, we are going to have our cost of asset here minus accumulated depreciation, and we are supposed to get the carrying amount at the end. So let me just check. Okay, so that is it. That is what we actually did. So here we now have so that's how they actually got this. So the first one we did here is we took our asset, the cost at the beginning, minus accumulated depreciation at the beginning as well. And that's what gave us this. Then at the end of the year, we check the total asset that we have plus the addition, right? Minus the total accumulated depreciation, and then we get our carrying amount for this thing. Let's now come to 2021. Let's see what happens in 2021. Let's just remember all this figure. Let's come to 2021. So in 2021, if you check 2021, you will see that our carrying amount as at the beginning became 20,000. So let's come back to this place again and see our carrying amount. So we have 20,310,254, and it's the same thing that we have here, 20,310,254, which is also year. There is no addition during the year, okay, and all that. So it's as easy as that. There is nothing difficult in preparing your whatever. Let's now go back to the beginning and let's check for the first thing that they did in 2010. Okay, so in 2010 now, because it's actually a new, because it's a they just started creating the asset. Opening balance as at this date, there was nothing, no opening balance, right? That means that they didn't carry anything over from 2009. They didn't carry anything over from 2009. Then addition during the year, they are not talking about all the assets that they actually purchased during the year. All the assets they actually purchased during the year was what they actually showed over here. Then the next thing, they now have their closing balance as at 31st, which is the same thing. Then because we already know that our depreciation value for motor vehicle is 20%, we are going to take, so for depreciation also, we don't have any accumulated depreciation at the beginning. We only took 20% of this value. So let's quickly check if it's correct. 20% of that value, or probably some of the values, okay, it's 20%. If you can check, 20% of this was what they have here. 20% is what, so this are 10%, 10%, 10%, okay? At the end of the day, you add this plus this plus this plus this together, you are going to get this. And this amount is what you're actually going to post to your depreciation account, and you also credit. So you can actually use journal to pass that. You can use journal to pass the entry. So let's do something. Let's do something, right? So it's very simple. So that is what it is. So it's very simple. So let's now come over here. Let's just try and do some things. So what I'm going to do is I want to duplicate this. If I duplicate these, I want to call these, like, let's say this is 2024. So we are trying to create, I want to show us now what we need to do. So let's say this is 2024, right? So 2020, or let's, yeah, 2024 accounts. So over here, at the beginning of the year, let's assume we don't have anything at the beginning of the year, okay? At the beginning of the year, we didn't carry anything over because it's a new, I'm just trying to show us how to go about it. It's a new company. We just started buying asset, right? We just started buying assets. So at the beginning of the year, there is nothing, right? So now in our postings, I told us that we purchased assets for 5 million. We check it, you discover I said we purchased assets for 5 million, not 50,000. Sorry, I said 5 million. 1, 2, 3, 1, 2, 3. Okay, purchase asset for 5 million. Then we can also go and say that our furniture and 15, we purchase it for 3 million. Okay, then our 3 million, 3, 1, 2, 3, 1, 2, 3. Then our office equipment, we purchase it for, like, let's say it's 7 million. 1, 2, 3, 1, 2, 3. Then our office equipment, we purchase it for office building, sorry. Office building, let's say is a 30 million. 30, 1, 2, 3, 1, 2, 3. Then for this one, we can, our software, we bought it for 20 million. Okay, so fine. So that is that. So there's no disposal. So there's no disposal, and accumulated depreciation at the first of the period as well. There is no, what's it called? There is no. Okay, so there is no accumulated depreciation at the beginning. So depreciation for the year now, what are we trying to do? We are going to say this is at 20%. This is, others are going to be at 10%. Even Okay, so even your office building, so let's take this away. The office building also is going to be at that value. Okay, your office building as well. And yeah, so everything is like, except for motor vehicle account, we assume that everything is going to depreciate over the period of what is it called. So at the end of the day, we are going to have yeah, so you can see here now, we can also have asset that was disposed. What was the cost of that asset, right? Then what is the accumulated depreciation on that asset, right? You can also have it over here. But for now, we are assumed that we are just starting out this account, and this is year 2024. I'm just starting out this account, and this is year 2024. Okay, fine. Then here we want to also have 2024 over here. Okay, so 2024. That's fine. So at the end of the period, you're going to see that your carrying amount as at the beginning of the year ought to be your opening balance for costs minus your opening balance for accumulated depreciation, which ought to give you your carrying amount at the beginning. Then as at the end, you also say your cost at the end minus your accumulated depreciation or your depreciation for the year, then minus. When you do that, you're going to get your carrying amount. But what I want to tell us is that you see that depreciation for the year, this is what actually goes to your POL. This is what you post to depreciation account. So let's now assume that we are now in 2025, or we ought to create account for 2025 now. So let's do something. So let's now do something now. We want to create account for 2025. We put this as 2025, and we put enter. So what are we going to do? We are now going to now say, okay, what is our asset as at 2020, as at January 2025? What is the cost of our asset at that date? Then as at the same date, what is our accumulated depreciation? So what is our accumulated depreciation as at that day as well? So we simply come over here, we click on equal to, right? We now come to 2024. We want to click on the balance as at that end. We click on it. Okay, so that's what we did here. Then we can go on to now just autofill like this. Okay, so this is how we're able to get our opening balance as at the beginning. We also want to get our opening accumulated depreciation as at the beginning. We also come over here, we say equal to. We want to go and check for our balance as at 31st. We want to click on this, right? We click here. Then we want to now take this and drag it to the end over here, and that is that. So now here, our carrying amount. Am I not getting what I'm supposed to get? Let me check. Okay. But this is not possible. Did I make a mistake in this thing I did? Yeah, so this is our carrying amount at the beginning. This is our accumulated depreciation over here. So I think I must have made a mistake. Let me check. Oh, there's a mistake actually. So this is not supposed to be. This is our depreciation. We come over here. We now come to our 2024. We want to click on this. So this is our accumulated depreciation. That's at the end of the year. And this is what we are going to drag from here down like this. Okay, so this is it. So at the beginning of the year, we got our total costs as at last year. The total cost as of last year is what we actually got. So which is going to be this. That means that whatever we have as beginning plus addition for the period, then if there's any disposal, I think this disposal is also going to be there, okay, which we make the total whatever. Then that's what we pick for our opening balance. Then for our closing balance, for accumulated depreciation, we also pick this one, which is going to be our opening balance in the next year. And that is what we had over here. So now we now have all these things. Let's now say that this year now, we now have some change in purchase of assets. So let's say this is 45,000, 45 million. This is 4 million. 1, 2, 3, 1, 2, 3. This is 6 million. And we bought additional assets for 10 million. Yeah, somebody wants to say something. Yes, I'm listening. Hello. Yeah, Bukola Adebayo.
I just wanted to ask. So at the beginning of 2025, I thought the
Yes.
value of our assets should now be 4 million since we've depreciated it by 1 million. Are we still carrying it as 5 million, sir?
Yes, we are. So, yes, so we are. So that is why I had to show us this, right? So whatever value you had at the 31st December for your asset, you see, we are taking the value, we are separating them. We carry one at, we are not using carrying amount. So don't forget, we are going to be showing costs as well. We're going to be showing accumulated depreciation. So what we did is that our balance as at 31st December 2024 for our asset at cost is what we're going to pick as our opening balance for the next year. So it's not the carrying amount. That's all we are. It's not the kind of amount that we're picking. We are picking the costs actually. So that is what we picked over there. So that is what we picked, and that is why we are having it over here. Madam, do you understand it? Also, the accumulated depreciation, okay, at the end of that same 2024 is what we are also picking over here. So the same effect is going to have the carrying amount to be whatever it is, which is 4 million, is what is also going to have over here. Since we actually took the total as at the end, we also took the total as at the end of 2024. So that's what we took, and then we came over here to put it that way. Okay. So when we have it that way, right, we are going to now the addition for the year we have we have 4, 500, 1, 2, 3. Then we have all this for the year. So we are going to add everything together, which is going to be this. This is going to be this closing balance of our cost is going to go to the next year as opening balance in 2026. So that's how it's going to be. So now this one now is like 2025. Yeah. So this closing balance as 2025, which is going to become opening balance as at 2026. Then here also it's also going to become this is going to become 2025. Fine. So what are we going to do now? We now have the total for the year, right? So since we add the total for the year, then this total is what we are going to depreciate. So let me just take us back to 2020. We see our 2020, right? We had our opening balance for the beginning. We also have our opening accumulated depreciation for the beginning. Then secondly, we also have our addition for the year. They added the two of them together, right? Which gives us this 2310. Now, is this same thing that they now also depreciated by taking 20% of it? So we now say 20 divided by 100 times 2310,254, which is giving us this value that is here. So that's what gives us this value that is here. So you see that you don't say that, okay, I've depreciated the one that is at the top before, so therefore I don't want to. You have to add everything together. So when we come to 2025 now, both this one and this one, they are all at cost. Add everything together, okay? Now, it's going to give us this amount. So for the year now, we will now charge 20% on it, and that is what is going to give you what is here, right? When you give you what is here, is what you are going to add together. You're going to add everything together. You're going to have this amount, okay? So this is the amount that are going to charge to your P or L. That is the accumulated depreciation for the year. Are we together? Are we together? Can anybody hear me?
We are. Yes, we
Okay,
are.
so let me now explain why. Because some people will say, why are we doing that? The reason we are doing that is because we know that this asset is supposed to last us for 5 years. We've charged the first in the first year. We are still having 4 years. So if we're in 2025 now, we still have the right to charge 20% on this asset. Then this is a new asset that's still going to last us for 5 years. We're also taking 20% now so that it will remain 4 years. So that is why in this year, we are not only saying, we are not only charging depreciation on this one, we are charging depreciation on both of them, because the 5 million is assumed that is having a 4 years remaining, while this 4.5 million is just beginning. So we are just charging the first one. So it means it has 5 years. We are taking only one out of it. And that's why we have this over here. So at the end of the day, the depreciation that you're going to charge for the year is going to be the addition of all these things together. And this is what you're going to post to your profit or loss account. And that is what you are also going to like. So it means that at the beginning of the period, when we started creating, right, in 2024, we would have passed an entry. What entry are we going to pass? We simply say, I hope you can still hear me. Can anybody hear me? Give me a thumbs up if you can hear me. Okay, fine. So now you discover that at the beginning of this period, when we started depreciating, this amount, the amount that is here, this amount, we have charged it to our profit and loss account. So when we charge to our profit and loss account, how do we do that? Our assets account, we have 65 million, right? So what we're going to do is that we are now going to debit our depreciation account in our profit or loss account. Then we're going to credit our accumulated depreciation account. So it will still balance. Why? Why is it going to balance? Because for any debit entry, there should be a corresponding entry. When we are having this 65 million, what did we do? We debit our asset account, we credit bank, the leg balance. When we now came to depreciate, we debit our depreciation expense account by 7,000, we credit accumulated depreciation account by 7,000. So when you come to 2025 now, in 2025, you are going to now say the charge for the year is actually 11,900,000. So what you need to do is that simply go and debit your depreciation expense account by 11,900,000 and credit your accumulated depreciation by 11,900,000. So you are going to use journal to pass it. So you don't need to go and do live posting. It's journal. You already know how to do journal entry. Now, apart from these that you're going to pass as journal entry, there's nothing else you're going to pass except for this asset. When these assets are purchased, the additional asset, you're always going to debit asset accounts and credit bank. Debit assets account, credit bank, debit asset account, credit bank, debit asset account, credit bank, and so on and so forth. Are we together? So if this is noted, then we can decide to try some postings and see how it goes if we are sure that we are together. Are we together? Are we together?
Yes, sir.
All right. So let's try and post what we just created now. Okay, we are going to use journal to actually pass them. We are going to use journal to pass them. So somebody's hand is up. Yeah, so if you have any question, kindly ask the question now. Madam Bukola, do you still have any question to ask? Or there is a chat. I am seeing this. I'm not seeing the screen. Is it for everybody?
No, some of us can see the screen.
Okay. Okay, thank you. So let's quickly.
So I wanted to ask a question.
Okay.
When we use in year 2025, and we use that total amount, that is for the cost of the asset. The addition, what if the additional asset was added like in for just 7 months, if it was used for just 7 months? Are we going to just do the 20% on it like that too?
Okay, so when you are doing not really. Okay, so this now you want to get a little bit complex, but just like the way the rule is, you can actually get what you want to achieve here. Let's assume that this stuff, one of it, this is obviously from last year, so we don't need to prorate it, right? But this is for this year, right? So let's say that this asset was actually purchased maybe in May, for instance. So we now say May, June, July, August, September, October, November, December. That is 8 months. So what we want to do is that when we come over here, we want to say 20% times. So we now come and do something like this. 20% times, let's say, we now use Excel actually. We can use Excel. We now say 20% times, I'm coming. Okay, 20% times these. Then we can say, yeah, no, most times, we normally say the total. Is the total that we normally pick. But if you want to do it individually, so let's try and do it individually. So we can say 20% times, let's say this is our D12, okay? 20% times FD12, okay? Plus, you can just do something like plus, just say 20% again, times, times 20, I'm coming. So times you open your bracket, you now say these amounts, right? Times, let's say like 8/12. You close your bracket and you click on enter. And that is how you're going to get it. So you can see the way I did this. And so you just need to separate it one after the other and not use the total. Just say, okay, 20% times 5 million, then 20% times plus 20% times this value times 8/12. And that is how you're going to do that. So, but the next month or the next period, it won't be the same because the next period you are going to get a total value. So just give me 2 minutes. Let me just attend to something. 2 minutes, please. Everybody, 2 minutes. Thank you. Okay, so let me ask. I'm sure you now understand how to go about what we've done, Madam Bukola. Do you understand how to get it he is not if he's not um a full month. So the next thing I want to do is
Yes.
let's,
Okay, sir. Thank you.
let's also learn how to now create a journal for it. Because most people, they might see it that way. They may not know how to create a journal for it. Okay, so let's try and create a journal for it. So this is what we're going to do. Let's come to, have I closed that stuff? Let me see. Okay, let me quickly go and create a journal for it. Let me open back my chart of accounts. Chart of accounts. I come here and I open here like this. Yeah, so then I want to open this. So let's quickly create chart of, let's quickly create journal for it. Okay, so already so let's create journal for it. So what we're going to do is let's just quickly copy this. Let's copy this. We don't actually need much. So what I'm going to do is let's go and check for our code under our expenses. What is our depreciation? What is our depreciation? Depreciation. Anybody can see depreciation. Okay, yeah. So this is depreciation. I think I saw it now. So this is our depreciation. This is the value. So we copy this. Control C. We come over back to this place. We want to paste it right over here. So Control V. Now the next thing we want to do is that we also want to go up and check for the asset involved, right? The asset involved. So for this one now, we are going to have the what kind of expense is it? This is an expense, obviously. So let's call it an expense account. So this is an expense account, expense. Then the next thing is how much is it? We come back to our sheet. Remember, I told us that is the depreciation for the year that you're going to pick. So we just come over here, we pick the depreciation for the year, which is this. You can even say from here, you can even link it, right? You can link it and just say equal to now come back to this come back to this place and link it equal to this value. Then click on enter. So then the next thing you want to do is that you want to create your accumulated depreciation. So let's go up and check for our accumulated depreciation account, which is our asset account. We come over to assets. Yeah, so we have accumulated depreciation, furniture, office equipment, and everything, land and building. Let's just copy them like this. Okay, I will copy them. Then we want to come back to this place and you want to paste them like this. Okay, so all these are all fixed assets. So we also want to come back and know that these are fixed assets. So this is fixed assets, fixed assets. Okay, so that is that. Fixed assets of the V. So the next thing you want to do is that you want to come over here and now start imputing most of the figures for that assets. So we've already created an expense. This goes to this one now goes to the expense account. Why these other ones they come to our asset account, which is going to be in our balance sheet, which is going to be under our accumulated depreciation. So the first one is land and building or building. Just really come and say equal to, they will come and select here, equal to the building. This is the building, accumulated depreciation for the period is this, right? We click on enter. Then for the next one is plant and machinery. Do we have any plant and machinery? I doubt, but let's check. Plant and machinery. We don't have. So equipment, furnitures and fittings. So let's go and check for other things that are there. Then we can pick up. Okay, so we have motor vehicle. Motor vehicle, we say equal to, we come over and pick motor vehicle. Motor vehicle. Motor vehicle. Yeah, I think it's this one. Then we have functions and fittings equal to, we come over here and pick it. So you can see that everything we are doing, we are not just assuming figures. We actually picking actual figures. So we come over here and select the last, I think it's the office furniture and whatever, office equipment. So we just click on these. Then I think this one, we can replace this one by putting computers and whatever. So some people normally separate their office equipment from their computer. Probably they want to be able to get a good grasp of how the computers are doing. Okay. So yeah, we change this one now from whatever, or let's just leave it as so this ought to be computer, but this is going to adjust our chart of account, which we don't want it to be. But I just want to show us that this is how you actually will post. So you simply go to your so you go and post this journal. Once you post this journal, automatically is already inside your account. So when you post it, no other thing needs to be done. That is the end. Unlike when you create your journal for expenses, where you are creating liability. But here we're not creating liability. Here we are actually not creating liability. We are only creating accumulated depreciation account. So it's going to continue to accumulate until at the end of the day, the total accumulated depreciation will become equal to the total. It's going to become equal to the total asset that we're going to have. So now to post this thing now, let's also go and check for our assets. So we have all the same assets. We have these, we have this, we have this. So let's quickly do something. Let's assume we also want to record our asset as well. So we also want to record our assets. So let's go and pick our assets. Our assets are going to be, let's see. Okay, so this is it. So these are our asset, land and building, furniture and fittings, and so on. So let's copy it. When we copy, we come down to this place. We come and put it right over here. Ctrl V. Then they're all fixed asset. We copy, we come and put over here. Fixed asset. Fine. Then the next thing we also want to do is we also want to go and capture our bank. So let's go to the top. What bank are we picking? Let's say we want to use cash and cash equivalent bank. So let's say we want to use our Fidelity Bank. We also copy these. And we copy, and then we'll bring it down over here. You can also use journal entry to pass it. That's what I'm trying to show us. So you also come over here, you put this one over here. So what do you want to do? For your bank, you are going to debit your bank with the total value of, let's say you want to debit your bank with a total value of, so this is the addition for the year, right? So you want to debit your account with the total of this. So let me come back to this, my place. Let me come back to this. Because the purchase is going to be just once. So you're going to debit, you're going to credit this account. You're going to credit this account by picking what is here. Don't forget that these assets, they were purchased in batches. The first batch was purchased in 2024. So 2025, we only pick this amount. We click on OK. Then we now come over to all these ones. We want to select for our land and building equal to, we're going to take our land and building over here, our land and building. So this is the amount. So also don't forget that you also need to, so this is for 2025. So you also need to create for 2024. This only for 2025. You need to create a accumulated depreciation for 2024 as well, and also create assets that you purchased in 2024 in order for this thing to actually make sense in your account, because the accumulated depreciation that we are actually picking, we are depreciating both asset that was purchased in 2024 and asset that was purchased in 2025. So you have to show the asset that was purchased in 2020. So let me just put here that this is 2025. 2025. So you need to also show what was purchased in 2024 in order for this thing to actually make sense. You need to pass all those things as a 2024. So once we have done, we've done this, then we'll go and select all the assets, plant and machinery. We're only going to select computer because we don't have plant and machine, we don't have computer in our own whatever. but let's just pick computer over here. So this is additional for the year 2025. Then our motor vehicle is going to be, let me see, our motor vehicle is going to be this value addition for the year. Then our furnitures and fittings is going to be this value. It's going to be this value. Okay, then our equal to our office equipment is going to be this value. Office equipment is going to be this value. Then the last one, our bank has been posted. So as we did for 2025, this 2025 account, you also need to, you pass this journal into your account. You also need to do for 2024 as well. And I hope that is fine. For 2024, you simply come to 2024 account, capture the assets that you have, also capture the expense for the period that goes to your depreciation in your POL account, and also you now pass the accompanying accumulated depreciation to the accrued expenses for each of those assets. So it means, number one, you are capturing your asset at cost, and you're also capturing your bank. Your bank is going to be credited by this value, and then your asset will be debited by this value. Each of the respective assets will be debited by this value. Then the next thing you also want to do is that you also want to now say that, okay, so another thing we can do, this is where Excel skills come to play. So under Excel skills, you can actually tell Excel to go to that sheet and look for all this value. So you don't need to bother yourself to be looking for this value yourself. You can use VLOOKUP. We can also use SUMIF, okay, and all that. So with this, I think we have come to the end of this class for tonight. We hope to do more tomorrow. So tomorrow we try and make sure that it makes more sense, and we can actually post them into the account. Are we together? So you can see the way assets are always treated. They are not difficult. It's just for you to practice it, master it, and then start posting. Just the way you are practicing your salary account and everything, that's the same way you need to practice how to get your depreciation account. So whenever you buy the asset, you are going to credit your bank and debit the asset. And that is what I showed us in this place. So in 2025, when we purchase additional assets, what do? We simply came here, we credit our bank, right? Then we debit the asset by the additions. That is for 2025. Don't make the mistake of carrying the total assets, because some of those assets were purchased in 2024. So that means that as we have done for 2025, you also need to have a journal that is dedicated to 2024. And then you now pass it in the account, and then in your accumulated depreciation account, you're not only going to have the accumulated depreciation for the year, you're also going to have for 2024 as well, so that everything will make sense. So I think with this, we have come to the end of this class. If you have any question, kindly ask now. Any question? So if you don't have any question, give me thumbs up and let's close for the day. That's good. Okay. So thank you for your time. Tomorrow we do more. Tomorrow we're going to now go and check how we can actually capture vendors. I told us that when you're using a free version of Zoho Books, you might not be actually allowed to pay your vendor in bits. For your invoice, you have no issue with your invoice. Your invoice will allow you to actually pay, to actually receive money from customers in bits, no issue. But for vendors, you won't be allowed to actually pay vendors in bits. It means that at every point in time, you're going to be treating your vendors on cash basis. But there's a way we are going to capture it in order for you to be able to treat your vendors in the right way, even if you are using a free Zoho book. And that thing we're also going to look at is we're also going to look at other transactions that can be done from the bank. So people are mentioning that how do they capture some of their transactions for prior period, which they have on their bank statement, and they want to impute it into the Zoho books. We're also going to capture that. Then we're also going to look at how to do bank reconciliation and how to do a lot of other things, how to transfer money in the bank. There are a lot of things that we have not captured, which we are going to be taking is one step at a time. So after the end of this lecture, I'm sure people that have challenge with assets, how to get assets, I'm sure this has been a thing of the past. Nobody will say it doesn't understand asset any longer. You know how to capture your asset, you know how to record your depreciation and accumulated depreciation and everything. So on that note, good night, everyone.